What's going on, ladies and gentlemen? Welcome back to another day, another video. And in this video, I'm going to be talking about how the Federal Reserve, how they're holding back right now on interest rates, and they're not increasing interest rate hike for the month of June. So let's get into this real quick. I'm going to go over some couple reports. Some reports I'm going to be getting from Barron's.com as well as livemint.com, so we can also go to those websites and check out the reports if you want more full details about it. So let's go into the reports. We have the Fed holds rates steady but signals more hikes later this year. So Federal Reserve official opted to hold the benchmark interest rate steady at the conclusion of today's Federal Open Market Committee meeting, skipping a rate increase for the first time in 15 months. Wow, so let's think back. Where's that data? So that means like ever since basically 2021, I think they started it. Forgot where I put the data, but I'll get back into the data and probably do another video about when they started, the different kind of increase they did. Because at first they started off with 25 basis point, they went up to 50 basis point, and at times we were doing increase at 75 basis point, 0.75%. But right now they're going to pause it, but signals more hikes will be coming later this year. So we got to figure out what's going to go on, because right now they are saying that they're going to pause it for now to see the reaction to what's been going on with them raising the interest rates, as well as with the inflation going down. So the call, which was expected, keeps the target for the federal fund rate at 5% to 5.25%, but leaves the door open for future increase that could come as soon as July. So that means that the next FOMC meeting, which will be in July, they might do an increase. And what I'm hearing is, if things are not exactly what they want, for example, if another CPI data come out and it's inflation is lower, or if another CPI data come out and saying that the job market is still hot and there's a lot of jobs within the market, and if more data coming out say that consumers are still spending money and there's no really end to consumers reducing their spending, then they might raise the interest by 0.5%, by 0.50%, which will be about 50 basis point at the next FOMC meeting, which will be in July. The bank had raised rates 10 times in an unbroken series of increase that began in March of 2022. There's the information we needed right there. I know I was looking at some other data that had like the tables of what kind of interest rate hike happened for each month, but there we have it. It begun in March of 2022, and we had about 15 increases and about 10 straight in a row. So holding the target range steady at the meeting allows the committee to assess additional information and its implication for monetary policy, the Fed said in the statement. Along with the decision to skip a hike, the Fed released a new summary of economic projection on Wednesday. Oh, I gotta read that one. Definitely got to check out the minutes on that one. On Wednesday, that includes the much-watched outline of officials forecasting on whether the interest rate will be by the end of 2023, also referred to as the DOT plot. So let me see. So officials trying to forecast on where interest rate will be at by the end of 2023, because remember, they want to have the inflation down to 2.0 to 2.5 at the most. So that means that they're trying to get the federal fund rate might go up to about maybe 6% or 6.25%. The majority of the members of the Federal Open Market Committee, which sets monetary policy, expect rates to rise further. As indicated, they believe additional tightening is necessary as the central bank will fight inflation. So as the central bank continue to fight inflation and continues to rise, then they will continue to raise the interest rate hike. And most likely they will raise the interest rate hike probably another 2 to 3 times. 9 of the 18 members expect to end the year with a benchmark rate between 5.5% to 5.75%, which will need another 0.5% increase, implying 2 more quarter points boost, while 4 official forecast rates would fall between 5.25 to 5.5%. 2 members said they thought rates would remain steady, while 3 predicted they would end above 5.75. Yeah, so between 5.5 to 5.75 is the majority. And we'll have to see about that when the next meeting comes up in July. So in March was the last time the Fed released the projection. Most FOMC members expected to end the year with a benchmark rate between 5% and 5.25%. That was back in March when they released those benchmarks. But now in June of 2023, the benchmark, they released in that it might go from 5.25% up to 5.75%. And that will be the Fed rate. That'll be the Fed benchmark rate, the federal fund rate, not the bank fund rate. That's the federal fund rate. So I mean, the bank's fund rate probably, well, you never know because different banks have different rates. So definitely, if we go up to the 5.75%, you will see banks probably increase their interest rate probably by about 2% or more. So let me see what else kind of information I got. So the U.S. FOMC meeting outcome, Federal Reserve Chairman Jerome Powell led Federal Open Market Committee voted Wednesday to pause this aggressive campaign of interest rates. Kind of weird because of how the market reacted to the pause of the interest rate hike, and the market kind of fell after the news came out. So we decided to pause the aggressive campaign of interest rate hikes despite elevated inflation, while indicating that another sharp increase could be needed before the year ended. After 10 straight increases since March of 2022, the Fed rate setting committee voted to hold the benchmark lending rate between 5% to 5.25%. The central bank said in a statement, holding interest rates steady gives policymakers at the FOMC time to assess additional information and its implication for monetary policy, the Fed said. So they got the CPI data, you have the PPI data, you have the job reports data, you have the unemployment data, I think also should be coming out. So they have to look at those data and assess the additional information to decide whether they're gonna do more Federal Reserve Fed rate hike for the rest of the year. So we might see one in March or September around that time when they have more meetings. So the U.S. Central Bank began its 2-day policy meeting on June 13th to set the benchmark lending rate amid cooling inflation in the world's largest economy. Because yesterday, the CPI report came out and saying that the CPI inflation rate was down compared to the month of April. So the members of the FOMC meeting did come together. They did go over their meetings. They did assess some information that they had, and also decided to vote on not increasing the Fed rate hike for this meeting. But coming up at the next meetings, maybe July, maybe the meeting after that, we might see another 0.25% or another 0.5% increase. It depends on how they look at the data and decides how the data and the policy should be made. So once again, it's Andy D. Hope you got some value out of this. Make sure you log on to Barron.com or also LiveMint.com, or also go to the Federal Reserve website and other places that you can find, like the Bureau of Labor and Statistics. You can find more information, as well as assess the additional information yourself, and try to have an idea of where the Federal Reserve will go with their monetary policy. So once again, it's Andy D. Hope you got some value out of this. Please like, subscribe, and leave a comment. Let me know what you think about the FOMC pausing their rate, and I'll talk to you next time. Peace.